Welcome to the Market Recap, your weekly digest of the biggest market stories from the past week. Join host Anna Sarin and financial expert Bruce Campbell as they go beyond the headlines to deliver cutting-edge insights into news that move the market. Proudly presented by the Canadian Securities Exchange.
Welcome back to another edition of the CSE's Market Recap. I'm James Black, and today I am joined by Mr. Jordan Youl, StoneCastle Investment Management, to break down all the happenings of the market over the past week. Jordan, once again, we are the B team. We are here filling in for Anna Sarin and Bruce Campbell, but that's okay. It's the dog days of summer. Sometimes people have vacation. Sometimes they have to be somewhere else. And we're more than ready for the task this week to break down the markets. So how are you doing?
Yeah, good. Good. Thanks for having me back.
Awesome. Well, I'm very pleased to have you back. And a lot to discuss. I mean, I did say it's the dog days of summer, but monumental things happening in the world of interest rates. And obviously, we'll break that down for everyone on the show today. A new issuer in particular we want to talk about at the CSE. You have to wait until the end of the show to find out who I want to mention. And other comings and goings in the market. So why don't we get right into it? The best I could define this first topic was reading the market. So I'm going to bring up a chart here in a moment. We are going to try to define what is actually happening in the market. And from your perspective, Jordan, with what's happening with interest rates, the Fed, the Bank of Canada rate, how is this impacting the stock market, first and foremost?
Yeah, the stock market, without question, has had a very tough first half of this year. You know, the long-term narrative still remains unchanged. You know, I was on the show a couple of weeks ago and we talked about our asset leadership model, where effectively we're ranking equities to other asset classes. And depending on the geographic region, you know, there are some bright spots, you know, Canada outperforming the S&P and other commodity-rich regions outperforming the S&P 500. But the takeaway here is that, you know, we remain in a risk-off market environment. The long-term trend of the equity market remains negative, and that coincides with the lack of market breadth as well. There's not too many sectors or industry groups that have performed well so far in 2022. But what we are seeing is a potential shift in leadership. Now, it is early, but we are starting to see some more appetite or accumulation in areas of the market that have been really beaten down and have really underperformed year to date. And that really coincides with the small cap versus large cap narrative. So we do have a chart of the S&P 500 small cap relative to the large cap. And effectively what this is a momentum oscillator. And it's really important to not only recognize the trend and what prices are doing, but we need that confirmation. You know, as prices are rising, we want to see the underlying momentum confirming that. We're not there yet, but what's really interesting is in the chart, we have a ratio of the small cap to large cap. And in the lower panel in the bottom right-hand corner, you can see that the two moving averages have actually just crossed over and turned positive. So what's really interesting is that we might be seeing a second half opportunity going into 2023 where the small caps could potentially outperform the large caps, because again, the small caps have really lagged and underperformed over the last 15 to 18 months. So we might be seeing a shift or changing of the guard favoring small caps over large caps moving forward.
Right. But we don't know if it's a particular sector. It's just, it is what it is, or is there something driving this?
Yeah, so there's a couple of things. Cannabis, which we'll touch on, which has been really underperforming for more than a year at this point, but technology, consumer discretionary, and industrials. And those are sectors that I touched on a couple of weeks ago in those relative rotation graphs where they're improving relative to the TSX. So from a market sector perspective, we are seeing a shift. Now, energy, which has been, the top performing sector year to date, has come off quite a bit over the last couple of weeks. So we are seeing, those dynamics shift where, investors are looking at not necessarily what has performed over the last, multiple quarters. They're like, well, what's going to perform or do well moving forward? And we're seeing a lot of non-commodity opportunities right now across market caps, but industry groups within the TSX and within the S&P 500, for example, as well.
Wonderful. Okay, well, we'll come back to one of those particular sectors in a few moments. Obviously, this week's big news was the Bank of Canada hikes the rate by 100 basis points. So maybe just explain in layman's terms, what's happening here as far as the actions of the Bank of Canada, and ultimately how that's impacting interest rates and the end consumers who are feeling the wrath of a high interest rate environment.
Yeah, exactly. So, if you go back beyond a year ago, we've been talking about inflationary pressure. The Fed talking last year about inflation being, transitory or just short-term, temporary. Well, that's obviously not reality, and that hasn't really transpired into real life. So the market has been anticipating that Bank of Canada, but also in the U.S., that the Fed is effectively going to be increasing rates aggressively to combat inflationary pressures. We're seeing it in the grocery stores, we're seeing it at the gas pump, and you can see on the chart on the left-hand side, the US CPI index, which was released earlier this week. The market was anticipating 8.8%, which was an increase in itself, but it surprised even more, and it printed at 9.1%. And we haven't seen these levels since the 1980s. So that kind of caught the market off guard a little bit. The Bank of Canada surprised the market. We were anticipating 75 basis point hike, but they actually increased 100 basis points. And that's not necessarily a bad thing. We all recognize the fact that, the Fed and the Bank of Canada is behind the curve, and they're really trying to front load this where they have, some flexibility maybe down the line to cut or do what they need to do if things do get worse in the economy. But without question, it definitely surprised the markets that the Bank of Canada did increase 100 basis points. And on the right-hand side of this chart, you can see what the market's anticipating the Fed to do next week. So 100 basis points was never really on the table, but you can see in the chart on the right-hand side, there's about a 69% probability that they're going to go 75 basis points next Wednesday, and about 30% probability that they're going to follow the Bank of Canada and increase rates by 100 basis points next week as well. But it is definitely impacting investors and just with spending habits as well. We've seen the Canadian banks come off a little bit this week. Mortgage rates have increased as well. So investors or individuals for that matter that are using variable rates, whether it's mortgages, line of credits, personal loans, what have you, it is definitely going to impact and affect spending habits as well as investors.
Yeah, not as many free lunches these days, and obviously paying at the pump, the grocery store, and we just seen here. I'll share a stat with you. Home prices have fallen for the fourth straight month. This is some data I'm just looking at here. So on a seasonally adjusted basis, the MLS home price index, which strips out month-to-month volatility, fell for the third consecutive month. It was down 1.9% month over month, but remains 14.9% higher compared to last year. So relative to last year, not so much, but recency bias would point to there being a drop in home prices, which I guess this was one of the missions here of raising interest rates, was to cool the housing market, because it was obviously out of control. Cost of capital was next to nothing, historically speaking. And here we are now with still a relatively hot housing market, historically based. So, how long do you think, and this is just a guess, how long do you think it's going to take for housing to correct, or at least get to a point where, we are sort of on safe footing here and things aren't overcooked?
We are, for sure. I think, I'm not a real estate expert, but I think this is more of a buyer's market now, where we have a little bit more flexibility. Prices locally here and across Canada, for that matter, have effectively gone parabolic. We've seen significant housing price appreciation over the last 6 to 12 months locally here, for sure. There's very little inventory. But it's that balance between, existing homeowners that want to try and downsize or get out and just try and get out at top dollar. But what's really interesting is the listings that are effectively on the market right now, the days on the market. That's starting to extend, and also just from speaking to a couple of realtors recently, and even mortgage brokers, a couple of months ago, if there was a listing, there'd be a lineup around the block, and they would have set dates and times to put in an offer. Wednesday from 1 to 3, place your offer, and that's how it is. Well, that's not really the case today. There's a lot of open houses, but there's not a lot of traffic or activity. So, if you're looking at getting into the market, it could be beneficial for buyers to try and pick up a property. But again, housing prices have effectively gone parabolic for sure. But what's really going to be challenging for homeowners, for existing homeowner, obviously it's the refinancing, and with the hike in mortgage rates now, and also as a new homeowner or new home buyer, getting pre-qualified, seeing if there's any inventory or anything in your price range, right? You still have to qualify at a higher rate now. Do you so it really depends, but without question, what we're seeing is prices are starting to come down or decrease over the last few days as a result of the most recent bank hike or
100%. Yeah.
So,
I mean, I see in my own neighborhood north of Toronto, house would go up, the sign would go up, and then within a day it would be down. And obviously the access to barely their interest rate, you could afford basically a bigger house or a more expensive house than you traditionally would if you didn't have to factor in such a high interest rate. So yeah, it's clearly getting back to that point where a lot of people just can't enter the market, and that's going to obviously soften things, but we shall see. It's I think the dream of every government is to have a lot of people, especially middle class, to own their house, and I'm not sure we are accomplishing that just yet. So we'll have to see how this all plays out.
Yeah,
and I think right now people just want to be able to buy bacon and gas. So
exactly. And we're seeing it on the interest rate spreads as well. There's been investors are extremely pessimistic right now and fearful about, what the future holds, because there's so many cross currents taking place. But, even looking at the yield curve, which is just really basic and widely followed, like that 2 and 10-year spread, is that, it's inverted, it's negative, but we're at levels last seen in 2006. And, when that happens, recession is imminent, right? Whether it's this quarter or early 2023. And, RBC came out earlier this week saying they're calling for a shallow recession in 2023, because you never know how bad it's going to be. But, it's on investors' minds, and that's going to impact real estate and other asset classes for sure. So, yeah, it really depends on the individual. But, obviously we got to work through a lot of things and get a little bit more clarity. We're heading into a midterm election as well. So, in the US. So yeah, there's a lot of things that, us as investors need to pay attention to for the opportunity set to make money in this environment.
Well, another great segue from you, Jordan. So more U.S. legislation on the table. This one, it's the Cannabis Administration and Opportunity Act, CAOA. Effectively, this would remove cannabis from the Controlled Substances Act. Removing cannabis from the Controlled Substances would allow U.S. cannabis businesses to access banking services, listings on national exchanges, and things like that. Now, the Senate has been a primary hurdle to federal cannabis reform, including the Safe Business Act. We've talked about that, which has passed the House of Representatives on 6 separate occasions. Again, this bill would likely face strong opposition by Republicans in Senate. And if you count the numbers, it's unlikely to be approved. But I mean, again, legislation continues to be forwarded for the advancement of cannabis to be descheduled. So in your mind, Jordan, you mentioned sectors that are perking up a bit, cannabis being one of them. Is this a response to this continued effort to loosen legislation, or at least change some of the rules around cannabis as it's seen by the lawmakers, so that it can be banked and it can be invested in on these exchanges? Is that affecting, you think, the pricing, or is there some other dynamics at play right now?
There's multiple factors, but without question, this is one major catalyst that can really drive the market. The cannabis sector in itself is a little bit different than, the stock market, in that it doesn't have a typically high correlation. So just because the stock market's going up or down doesn't necessarily mean the cannabis is going to mimic the pricing action of the market, because, it's such a unique industry in itself. But as you mentioned, this catalyst could really get this sector going. And, we did a webinar earlier this week. It's our monthly market update webinar, and where we talk about, these sectors that are improving and exhibiting signs of relative strength to the markets. And as investors, we're always looking for opportunities to make money, regardless of what the economic backdrop's telling us or whatnot. And cannabis is one of those sectors that is really outperforming as of late. And that could be a function of just more attractive valuations. They've come off a considerable amount off their most recent highs. They've really lagged and underperformed for the last 18 to 24 months, really out of favor. So, deep value investors that could stomach a little bit of volatility and have a longer time frame to invest, it's attractive to look at some of these MSOs and CSE listed issuers if you're a longer term investor. But to your comments and to your point, any type of cannabis reform is positive, right? That's indicating to the market that lawmakers are doing what they can to push legislation forward. So as a result of the news, it's been quiet. This particular bill was introduced or brought up July of last year, and it's been pretty quiet up until recently. So This is a reason as to why we've seen a lot of these MSOs perform very well this week. So we definitely have our eye on the sector for sure. But as you mentioned, it needs to get through the Senate. It needs about 60 votes. So there might be some pushback. It might not get approved or passed through next week, but at least they're working towards it and trying to bring it forward. So, but yeah, it's going to create a lot of opportunity, especially if these MSOs or companies become listed. They're going to have access to capital. They can do bought deals, different financings. It'll increase M&A activity. So yeah, it's definitely a major catalyst for the sector. For sure. So we need to keep our eye on it. So that's something that we're watching very closely next week.
Yeah. And another great segue, because just this week, the CSE did welcome MRMD. And another U.S., I'll give you a little rundown. MRMD is a multi-state cannabis operator. It's dedicated to improving lives every day through its high-quality products, its actions, and its values. This is from their write-up on the CSE's website. Now, MRMD, you can learn more about them at www.thecse.com. We did have a market open with them that you can also watch here on CSE TV. And we did talk to some of their leadership about the company and its ambitions. But one thing I'll note about MRMD, they've actually been in business since 2012. So this isn't a new company. But to your point, what I'll say is this is a maturing sector. It's a maturing group of businesses across all the multi-state operators who are continuing to improve their efficiencies, but also their performance. And I think as a sector, it's just something where the longer this goes on, you're just going to see more trust in the market that these are not businesses. They're not fly-by-night operators. They're not going to be, crushed by a good or by bad markets. They continue to expand and improve their operations as best as they can within the current national framework for cannabis companies. So just a heads up, MRMD, that's MRMD on the CSE. They have a long-standing history. Last time I checked, about 300 million market cap here in Canada. So not a small operator by any stretch of the imagination. And just want to formally welcome them again to the CSE. And, I can't speak to other companies that may or may not be coming, but Jordan, I think there will be more. I think there are going to be some companies that have these rich histories, these longer histories. And as you say, the types of deals that will occur on the market will reflect what's available to them. So we've seen, obviously, in the past year, some serious M&A activity, most recently between Cresco and Columbia Care. And these are some of the opportunities that, investors can have, whether they're on the acquirer or side or the acquiree side. Mm-hmm. There's a lot of value in these companies when they're trying to capture more market share by acquisition. So not sure I have any more notes on the cannabis space, but, for sure that the CSE, this has been a major catalyst for us. And
absolutely. Yeah. We've talked in great lengths about the MSOs for maybe the last year and a half. We're shareholders of multiple multi-state operators as well. And yeah, to your point, it's going to create a lot of opportunity. There's going to be many more to come. But I was even reading a note from one of the sell side research firms this morning, and it's interesting, with the Canadian dollar being so weak, we're around 24 month low. There might be an opportunity for some of these MSOs to look at Canada, for investment opportunity as well. We always focus on, what's going on south of the border, but a lot of those MSOs, from an opportunity set, might be able to acquire and pick up some really cheap assets, because up here in Canada, we've definitely felt the pain, right? So I think it could create investment opportunities for M&A activity and to expand outside of the US. A lot of them go international and have assets and revenue from other sources beyond the US, but we don't want to forget about Canada either, right, for investment opportunities in the sector.
No, no, there's been some really interesting retail brands that have been developed out of Canada as well on the cannabis side. And again, a lot of money spent, growing and expanding product lines here in Canada that might be of use or to the interest of someone in the US. But TBD on that one. Looking forward to the week ahead. I know it's the middle of summer. Everyone's at the cottage. Everyone's just, trying to spend their money before it's meaningless here in the bank accounts. But what do you have ahead for the week?
Well, the big focal point next week is going to be the Fed in the US, and the expectation that they're going to hike. Whether that's 75 basis points or 100 basis points, we will see, and the markets will effectively react based on the announcement and what is said after the effect. We're really, we kicked off last week, but with earnings season, a lot of companies are reporting, and it's not so much what they did last quarter, but it's their guidance moving forward. One of the US banks, they missed badly last quarter, but the market is rewarding them because they have increased their cash on hand with the expectation that they might experience more defaults through their lenders. So they're trying to position themselves. So, if the economic backdrop is going to worsen, they are taking action to protect themselves if things do get worse. So we just really need to look at each and every company and analyze, the reports and their guidance moving forward. And then we'll just really keep our eye on some of this internal rotation that's taking place. We typically see these 18 to 24 month cycles where, small caps are in favor, like, off the March low of 2020, where they have a really parabolic up move and then they correct and pull back and they become out of favor, like we've been going through since February of last year. But we are starting to see some subtle signs of improvement and rotation internally within the markets. And as investors, we're always looking for, the next big opportunity. And as I mentioned, there are sectors, including cannabis, that we're watching very closely. So we just want to capitalize and make sure we're positioned appropriately to capitalize on new trends that are starting to emerge.
That's right. So that's why you guys are there. You're the pros. You help manage the money and make sure people don't let it sit in a bank account and rot away for the foreseeable future. Jordan, I want to thank you again for joining us for the market recap. I'm James Black. This is a presentation of the CSE. If you like programming like this, if you like this show in particular, just hit subscribe or like or thumb up or wherever you're watching. The CSE is more than happy that you've joined us for today. Have a wonderful weekend, Jordan, and we'll hope to see you soon. If not next week, 1 week in August, we'll do this again.
Sounds good. Looking forward to it.
Thanks a lot.